Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing is entitled The Federal Regulator's Response to Recent Bank Failures. And without objection, all members will have five legislative days within which to submit extraneous material to the chair for inclusion for the record. I now recognize myself for 4 minutes to give an opening statement. Today, let's put aside the pre-baked narratives that have dominated the political discourse. We're here because the American people deserve answers. Before we draw conclusions on regulation or changes to law, we need to establish the related facts. In the run-up to its failure, Silicon Valley Bank experienced rapid growth, relying on undiversified and deposit base and investments made risky by a high inflation environment. We know the bank was mismanaged. That much is clear. Now we need insight into the decisions and decision-making process of financial regulators related to the second and third largest U.S. bank failures. We need insight into those key days in March when an idiosyncratic bank became a systemic risk, spawning a large-scale financial intervention that's still ongoing. Vice Chair for Supervision Barr, you've been on the job for less than a year. You came to the job well qualified. However, you made time to start a review of climate risks in banking and a review of capital standards for larger banks, with no mention of changes to bank supervision or liquidity provisions, two matters at issue with this bank failure. In fact, I've never heard you say to Congress that you didn't have the tools to do your job. In fairness, though, neither Dodd-Frank nor that technical corrections law, S-2155, dealt with issues presented in March. A digital bank run, the speed and volume of which had never been seen before. This committee would like to understand your thinking in the key hours of that first week in March, where your decisions had a mighty impact. Was there adequate planning for a large-scale bank run? Did the chief supervisor follow the playbook to ensure the bank did not fail? How did the chief supervisor and examiners miss the hole in the bank's balance sheet? These are related questions. Additionally, the committee has no insight into the decision-making or the actions of the FDIC chair on Friday the 10th through Sunday of that week when that systemic risk exception was announced. Again, did the FDIC chair use all the tools at his disposal to resolve the banks that weekend? Was there a viable private sector solution? There are reports that multiple banks were interested and ran the traps internally to purchase Silicon Valley Bank that weekend. You confirmed as much yesterday, Chairman Gruenberg. But as we all know, Silicon Valley Bank was not purchased until late Sunday, March 26th, at an estimated $20 billion in losses to the Deposit Insurance Fund. Why wasn't a potential buyer accepted sooner? Was there an ideological lens that prevented the FDIC from pursuing a private sector solution that could have staved off the uncertainty of the last 2 weeks? We know on Sunday, March 12th, another bank is shuttered and placed into FDIC receivership, and together this is deemed a systemic risk event. That evening, the Financial Stability Oversight Council meets in executive session. No meeting minutes, no transparency for the public, just an announcement after the fact. That lack of transparency has a negative effect on the public view of the safety of the financial arena. Congress needs visibility into how and why this determination was made by the FDIC, the Fed, the Treasury Secretary, the FSOC chair, and the President. I'll finish with this. We need competent financial supervisors, but Congress can't legislate competence. Today, this committee wants to understand your thinking in those key moments and that decision-making in a moment of stress in our banking system. Thank you for being here and your willingness to give answers to our questions. At least that's the hope. With that, I now recognize the ranking member for 4 minutes.
Good morning. I'd like to thank Chairman McHenry for working with me in a bipartisan way on investigating the failures of Silicon Valley Bank and Signature Bank. Today's hearing is the first of what I expect to be several hearings on this important topic. Chair Euenberg, Vice Chair Barr, and Undersecretary Lang, the collapse of SVB and Signature Bank earlier this month marked the second and third largest bank failures in U.S. history. In fact, SVB customers withdrew a staggering $42 billion in less than a day, making it the largest bank run ever and threatening to snowball into a full-blown banking crisis. But 2023 is not 2008 because of the Dodd-Frank reforms Democrats on this committee passed, as well as the bold and swift response by President Biden. Secretary Yellen and our banking regulators, a crisis was averted and our banking system remains strong. However, these events are a wake-up call. We must uncover how management, regulatory, and supervisory failures contributed to these events and explore solutions to strengthen the safety and soundness of our banks. Small business owners should not be expected to serve as a financial regulator when paying their employees, and community banks and minority depository institutions should not have to pay for the failures of bank mismanagement at SVB or Signature Bank. Since day one, SVB's collapse, committee Democrats have been on the case. In fact, under my leadership as ranking member, we quickly organized several bipartisan briefings with our nation's regulators to better understand what happened, share what we were hearing from constituents, and urge regulators to act. Since then, we've sent letters demanding answers from our regulators. And in response to Biden's call to Congress, I and my colleagues are working on legislation to, for example, enhance clawbacks and other penalties. We also need answers from the CEOs who not only ran these banks into the ground, but enriched themselves. It is also important to know how we got here. Deregulation. Former and disgraced President Trump said he'd do and I'll quote, a big number on Dodd-Frank, and his appointed regulators did just that. At that time, I sounded the alarm on the dangers of weakening capital and liquidity rules for banks like SVB. The light touch cautions from the Fed to SVB management are clearly not what Congress intended for bank supervision. I hope Republicans will join Democrats in strengthening compliance with bank rules and transparency over this process. Before I close, I want to address the extreme MAGA Republican narrative about the bank failures. Let me be very, very clear. Silicon Valley Bank collapsed because of management failures and possible regulatory weaknesses, not because there was one black man on the board. We saw the same racist playbook during the 2008 financial crisis when some Republicans blamed the Community Reinvestment Act and loans made to people of color. Rest assured, Democrats will not stand for this blatant racism. With that, Mr. Chair, I yield back the balance of my time.
We'll now recognize the Vice Chair of the full committee, Mr. Hill, for 1 minute.
Thank you, Mr. Chairman. Today we're confronted with the results after 10 years of too loose monetary policy and recent wildly excessive spending. Some bank management teams have forgotten their prudential obligations to their depositors and their shareholders. And clearly, many customers forgot their own prudence and their own financial responsibility. But as our committee comes together, the chair, the ranking member, and members are concerned about the supervisory failures by the regulators who are supposed to keep a watchful eye. Some lawmakers have been quick to use this crisis to put politics to push their preferred policy outcomes. But that's premature. We need to first understand what happened, when, and why, both leading up to the bank failures as well as the decisions made by your agencies represented in our panel today in response. Only then can we decide the proper path forward. That's why Republicans are conducting a comprehensive review, starting with oversight letters to the Federal Reserve, the San Francisco Fed, the FDIC, the FSOC, the California and New York state regulators. We expect your full cooperation in this matter, and make no mistake, today's hearing is just a first step in that process. I thank the chair for the hearing, and I yield back.
The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair McHenry and Ranking Member Waters, for convening at this crucial time, and thank to our esteemed witnesses for being here today. I remain proud of what we did almost 13 years ago with the Dodd-Frank Act. Although COVID presented novel and considerable challenges to our banking system, the system held. And these recent events represent the first real stress event since the 2008 crisis, when banks dealt with run risk and serious liquidity concerns. What we've learned is that we now have to reinforce our banking system against bank runs that can occur at the speed of the internet. This will require stronger emergency liquidity provision to banks under attack, and it has to be available 24 hours a day, 7 days a week. This will then require liquidity providers to have a clear and simple means of knowing that they are loaning to an entity which will ultimately remain solvent. I also believe that we have a lot to learn by the two side-by-side bank failures, Silicon Valley Bank with total assets less than 1% of GDP, and Credit Suisse with total assets greater than 100% of Swiss GDP. And the difference, I believe, is contingent capital. Had we followed Congress's direction to include contingent capital into the stacks of U.S. large banks, we would have been able to resolve the SVB without hitting the Deposit Insurance Fund. And I'll be bringing that up in my questions and yield back.
Today we'll hear testimony from the Honorable Michael S. Barr, Vice Chair of Supervision of the Federal Reserve Board of Governors, the Honorable Martin J. Grunberg, Chairman of the Board of Directors of the Federal Deposit Insurance Corporation, and the Honorable Nellie Lang, Undersecretary for Domestic Finance of the U.S. Department of Treasury. We thank each of you for your time, and we're going to be recognized for 5 minutes for an oral presentation of your written testimony. We'll begin with you, Mr. Barr.
Chairman McHenry, Ranking Member Waters, and other members of the committee, thank you for the opportunity to testify today on the Federal Reserve's supervisory and regulatory oversight of Silicon Valley Bank. Our banking system is sound and resilient, with strong capital and liquidity. The Federal Reserve, working with the Treasury Department and FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that we are committed to ensuring that all deposits are safe. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as necessary.
If the gentleman will dispense for a second. Mr. Foster, you'll turn off your mic. Thank you. We'll let you continue. Thank you.
Shall I proceed?
Oh, all right. Go ahead. If everybody will check your mics and make sure you're off. Did you just do that to Mr. Torres? All right. See, we can even have a sense of humor in the midst of serious stuff. We'll let you continue. Thank you, Vice Chair Barr.
Thank you, Mr. Chair. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as needed to keep the system safe and sound. At the same time, the events of the last few weeks raise questions about what more can be done and should be done so that isolated banking problems do not undermine confidence in healthy banks and threaten the stability of the banking system as a whole. At the forefront of my mind is the importance of maintaining the strength and diversity of banks of all sizes that serve communities across the country. SVB failed because the bank's management did not effectively manage its interest rate and liquidity risk, and the bank then suffered a devastating and unexpected run by its uninsured depositors in a period of less than 24 hours. Immediately following SVB's failure, Chair Powell and I agreed that I should oversee a review of the circumstances leading up to SVB's failure. In this review, we are looking at SVB's growth and management, our own supervisory engagement with the bank, and the regulatory requirements that applied to the bank. The picture that has emerged thus far shows SVB had inadequate risk management and internal controls that struggled to keep pace with the growth of the bank. Supervisors began delivering supervisory warnings near the end of 2021. Our review will consider whether these supervisory warnings were sufficient and whether supervisors had sufficient tools to escalate them. We are also focusing on whether the Federal Reserve's supervision was appropriate for the rapid growth and vulnerabilities of the bank. While the Federal Reserve framework focuses on size thresholds, size is not always a good proxy for risk, particularly when a bank has a non-traditional business model. Turning to regulation, we are evaluating whether application of more stringent standards would have prompted the bank to better manage the risk that led to its failure. We are also assessing whether SVB would have had higher levels of capital and liquidity under higher standards, and whether such higher levels of capital and liquidity could have forestalled the bank's failure or provided further resilience to the bank. We need to move forward with our work to improve the resilience of the banking system, including the Basel III Endgame reforms, a long-term debt requirement for large banks, and enhancements to stress testing with multiple scenarios so that it captures a wider range of risk and uncovers channels for contagion, like those we saw in the recent series of events. We must also explore changes to our liquidity rules and other reforms to improve the resiliency of the financial system. In addition, recent events have shown that we must evolve our understanding of banking in light of changing technologies and emerging risks. Part of the Federal Reserve's core mission is to promote the safety and soundness of the banks we supervise, as well as the stability of the financial system, to help ensure that the system supports a healthy economy for U.S. households, businesses, and communities. Deeply interrogating SVB's failure and probing its broader implications is critical to our responsibility for upholding that mission. Thank you, and I look forward to your questions.
We'll now recognize Chairman Gruenberg.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, thank you very much for the opportunity to appear before you today to address the federal regulator's response to the recent bank failures. On March 10th, just over 2 weeks ago, Silicon Valley Bank, or SVB as it's known, with $209 billion in assets at year-end 2022, was closed by the California Department of Financial Protection and Innovation, which then appointed the FDIC as receiver. The failure of SVB, following the March 8th announcement by Silvergate Bank that it would voluntarily liquidate, signaled the possibility of a contagion effect on other banks. On Sunday, March 12th, just 2 days after the failure of SVB, another institution, Signature Bank of New York, with $110 billion in assets at year-end 2022, was closed by the New York State Department of Financial Services, which also appointed the FDIC as receiver. With other institutions experiencing stress, serious concerns arose about a broader economic spillover from these failures. After careful analysis and deliberation, the boards of the FDIC and the Federal Reserve voted unanimously to recommend, and the Treasury Secretary, in consultation with the President, determined that the FDIC could use emergency systemic risk authorities under the Federal Deposit Insurance Act to fully protect all depositors in winding down SVB and Signature Bank. It's worth noting that these two institutions were allowed to fail. Shareholders lost their investment, unsecured creditors took losses, the boards and the most senior executives were removed. The FDIC has authority to investigate and hold accountable the directors and officers of the banks for the losses they caused to the banks and for any misconduct in the management of the banks, and the FDIC has already commenced those investigations. Further, any losses to the FDIC's deposit insurance fund as a result of uninsured deposit insurance coverage will be repaid by a special assessment on banks as required by law. The FDIC has now completed the sale of both bridge banks to acquiring institutions. My written testimony today describes the events leading up to the failures of SVB and Signature Bank and the facts and circumstances that prompted the decision to utilize the authority in the Federal Deposit Insurance Act to protect all depositors in those banks following those failures. It further describes the management and disposition of the bridge institutions that were established. It also discusses the FDIC's assessment of the current state of the U.S. financial system, which remains sound despite these events. And in addition, it shares some preliminary lessons learned as we look back on the immediate aftermath of this episode. In that regard, the FDIC will undertake a comprehensive review of the deposit insurance system and will release a report by May 1 that will include policy options for consideration related to deposit insurance coverage levels, excess deposit insurance, and the implications for risk-based pricing and deposit insurance fund adequacy. In addition, the FDIC's Chief Risk Officer will undertake a review of the FDIC supervision of Signature Bank and will also release a report by May 1. Further, the FDIC will issue in May a proposed rulemaking for the special assessment for public comment. The bank failures demonstrate the implications that banks with assets over $100 billion can have for financial stability. The prudential regulation of these institutions merits serious attention, particularly for capital, liquidity, and interest rate risk, and also the consideration of a long-term debt requirement to facilitate orderly resolution. Recent efforts to stabilize the banking system and stem potential contagion from these failures have ensured that depositors will continue to have access to their savings, that small businesses and other employers can continue to make payrolls, and that other banks, small, medium, and large, can continue to extend credit to borrowers and serve as a source of support. The FDIC continues to monitor developments and is prepared to use all of its authorities as needed. The FDIC is committed to working cooperatively with our counterparts at the other federal regulators, as well as with policymakers in the Congress, to better understand what brought these institutions to failure and what measures can be taken to prevent similar failures in the future. Mr. Chairman, that concludes my statement. I'd be glad to respond to questions.